The International Monetary Fund, the IMF, is voicing new concerns about coronavirus. An IMF spokesperson says the organization is likely going to downgrade global growth due to the outbreak. And joining us to discuss is NYU Stern School of Business economics professor Nicholas Economides. So, Nicholas, thanks for coming on.
Thank you.
Is there any chance that there's an overreaction right now, that stocks are overreacting, that it's not time for panic? Because then you hear something like this from the IMF and you think, okay, it is very, very bad.
Well, I think there are two different stories. I mean, on the one side, it seems to me like this correction is because of fear rather than actual data. We have not had cases in the United States, and cases in the West have been limited. So most of the impact has to do with China, maybe to some extent South Korea, and so on. So what is missing is an actual computation, an actual quantitative work that would say the supply chain of this company and that component and so on is in trouble, and also whether which sectors are in trouble. Obviously, airlines are in trouble, right? But
casinos in Macau.
Yes, but in terms of restaurants in New York, I don't see them in trouble. There are restaurants in Italy, in Milan, that are in trouble, but not here. So I think that it's a bit of an overreaction, and you have to keep in mind that we were at an all-time high. So that's part of the story.
Maybe headed for correction anyway before this.
Yes.
If we do start to see changes to those economic forecasts, not just here in the United States, but also globally, do you think, at least even here at home, that the Fed's going to want to keep that party going and give us a rate cut? Do you think that banks, overseas global bank heads, are going to make similar moves as well?
Well, I think that it's likely, at least for the U.S. Fed, to cut rates, and even earlier, because they have certain deadlines in which they could do it. They might come out and say something which would be positive for the markets to change the mood. And in the past, they have done this kind of stuff repeatedly. And the whole rally has been, to a significant extent, sustained by Fed moves. We shouldn't kid ourselves, right?
Now, it's interesting when you say maybe there would be more cause for concern if we saw, X, Y, and Z huge companies, really their supply chains really are being affected. Now, to be fair, some companies have come out and said, we're going to have a revenue hit in Q1 because of coronavirus. Nike, Adidas, Puma, companies that source a lot of stuff from China, the auto industry, now that South Korea is involved because car companies source a lot of parts from South Korea. But do you think, I guess, that most of those warnings have just been short-term issues?
I think some companies have to warn because otherwise they would be in trouble. I mean, they would be they don't have...
Full disclosure.
Yeah. So, but at the same time, I think that if you're a CEO, it might make sense to come ahead of the curve and say, look, I might be in trouble. So in the end, when the earnings come, people are going to say, well, he told us before, let's bump the stock up now a bit because of that. This is maybe the general attitude. But I think that what we see in the present stock market in the last week has been much more fear than based on reality.
But isn't a huge component of the market, especially what I see in America, very emotional, and it always is? And President Trump says, I want to be a cheerleader for the country. And it's like, so we look at it through these very number lenses at points, but it's always been, I feel like, a huge emotional component to everything.
Absolutely. And that's because there are a lot of individuals who have money in the market. So one thing we should look at is whether it's individuals who are selling or companies, funds that are selling. And most of the time when such a correction happens, it's the funds that sell first because they are professionals, they look, and they would be judged terribly if they didn't sell in the middle of
Not to mention just algorithms.
Yes.
That react to certain keywords and headlines.
Yes, absolutely. So I don't know the data on that, but I think we should look at whether individuals are selling.
So we talk a lot, obviously, that a recovery is definitely going to be coming. This fear might be very short-lived. How nice of a recovery, though, do you think it's going to be?
That's
or none.
That's very hard to predict. I mean, it's very hard. I think a lot of things will depend on actual reality. I mean, are we going to have cases in New York? Are we going to have cases in the United States? And how many? These are stuff that haven't happened. And so we're kind of in the beginning of a crisis. People are very afraid, but we don't know how deep or extensive this crisis is going to be. So it's very hard to predict the recovery. It will depend a lot on how deep and extensive the crisis is.
Yep, stay calm. All right, NYU Stern professor Nicholas Economides, thank you. Thanks for joining us.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.